Hello everyone, and welcome to a new series we're hosting called Money Smart Teens. My name is Marcy Nelson, and I'm the Head of Youth Services for the Livingston Parish Library. This video series is based on the High School Financial Planning Program created by the National Endowment for Financial Education and in partnership with the United States Department of Agriculture, the National Institute of Food and Agriculture, and America's Credit Unions. This series is designed for students age 12 and up and will be divided into 6 modules. Each module has a corresponding workbook that can be picked up for free at any of the 5 branches of the Livingston Parish Library. Once the 6 workbooks are completed, your child or student can bring those workbooks into their library branch and receive an official certificate of completion from the National Endowment for Financial Education itself. Because we have limited supply, if you are a teacher, we ask that you visit the official site at www.hsfpp.org to order workbooks and certificates for your classroom. It's super easy and it's totally free. Have your students follow along with these videos and the course will practically teach itself. Welcome to Module 2. This module is called Borrowing. Use, don't abuse. This module has 5 lessons with multiple exercises in the workbook. We're going to cover all 5 lessons in this video, but feel free to pace yourself and come back as you complete one lesson at a time. Let's get started. Let's talk about using credit. Today, you will examine the reasons why people use credit. Credit cards, auto loans, home mortgages, pawn shops. You've probably heard a lot about these forms of credit over the years, good and bad. But credit itself is actually neither. Credit is merely a tool to buy something now while allowing yourself to pay for it later. Credit itself is neither good nor bad. How we use credit is what's good or bad. None of your favorite products would exist without credit. Businesses borrow money to make product and later pay back those loans with the profits from selling those same products. Borrowing can also be a lifesaver in emergencies. Hospital bills, vehicle repairs, all sorts of unexpected and often pricey expenses can add stress to life. With credit, you can make sure those expenses are covered now while saving yourself the stress by being able to pay it back later. On the other hand, too many people eagerly buy now without thinking about their ability to pay later. This leads to owing money for purchases they may not remember or really don't need in the first place. And they end up paying more than the original cost of the item due to interests or late fees. So, what is good or bad when it comes to credit? When is it okay to borrow, and when is it really not a good idea? Here's a little prep work. Think about and answer the following questions. Why do people borrow money? When is it acceptable and unacceptable to use credit? How does borrowing impact spending power? As we go through the lesson, you will use what you learn to recognize situations when it makes sense to either use credit or to avoid using credit. Meet Mariah and Jessie. Mariah is a high school junior who lives at home with her mom. She's a part-time job and is responsible for her own expenses. She is saving for college and wants to apply for her own credit card. When she approaches her mother about helping her do so, her mother refuses and will not discuss the matter with her. Jessie is a high school sophomore. He lives at home with his family and currently has no job. He is saving money to buy a truck when he gets his license because he doesn't want to drive the family clunker. After realizing how much trucks cost, Jessie's brother suggests that his parents may agree to co-sign a loan for him. But Jessie really doesn't want a monthly payment. Both Mariah and Jessie will join us on our journey as we talk about borrowing and debt. Quick recap. We mentioned that credit is a tool that allows us to buy now and pay later. We also discussed that while credit itself is neither good nor bad, how we use credit can be either good or bad, depending on the need and our money habits. Boosting your borrowing IQ now will prepare you to make smarter decisions whenever you decide to take the credit plunge. Consumer spending fuels a whopping 70% of our nation's economic growth. When consumers spend more money, demand for products and services increases. To meet the new demand, companies buy more equipment, hire more workers, and give more pay raises. That means these employees now have more money to spend, and the cycle of economic growth continues. Borrowing is one way consumers can spend more when their income isn't increasing. That can help the economy grow. But as we've seen in recent years, too many consumers borrowing more than they can afford ultimately can end up hurting the economy. There are several different credit options available to consumers. Revolving credit, like a credit card, allows you to borrow for multiple purchases without going over a limit. Then, you repay what is owed a little at a time each month. Installment credit, like a car loan, allows you to borrow a specific amount of money to buy now, and you then make regular payments over time by a set date. Cash loans allow you to borrow a specific amount of cash in hand to repay later by a set date. Service credit, like cell phone or electricity bills, allows you to utilize a service now with the promise that you will pay for those services each month. Money that needs to be repaid is something to include in a spending plan. This will require adjusting allocations for other expenses. Looking at these tables, how might Jesse adjust his spending plan when he has to make a $200 monthly payment for a truck loan without increasing the total expense amount? What expenses are needs and which ones are wants? Does Jesse really need to spend money on entertainment? What about food and clothes? Could Jesse eat home more often? Does Jesse really need $100 in new clothes every month? What are your thoughts? Let's look at gratification now versus gratification later. Instant gratification is an unwillingness to give up something now in return for something later, while delayed gratification is a willingness to give up something now in return for something later. Think of a time you didn't wait to make a purchase and got burned. Was there a time you did wait and were rewarded for doing so? How can having a credit card impact your ability to delay gratification? Remember our stop, drop, and think before you buy method? Those same questions can apply to using credit. Do you need it or want it? If it isn't a need, then why do you want it? Exactly when will you use it or wear it? Can you find it somewhere else for less? What will you have to give up or put off by using credit to buy this now? Imagine you are Mariah, or even her mother. How will you justify whether or not she should have her own credit card? Aside from the information given to you earlier, what other information could be useful in helping you make your argument? On page 6 of your workbook, you will find Activity 2.1, Borrowing Fitness Test. Answer the following questions honestly. Do you repay money loans from friends and family before they have to ask? Do you borrow money often to pay for something you can't afford right now? Do you return library books or other borrowed items before they are due and in good condition to avoid fees? Do you frequently ask for an advance on your paycheck or allowance? Do you replace money you borrow from your savings account or other spending plan funds? Do you borrow items from your parents or siblings without asking permission? Do you know how much money you owe others right now? Do you ever make monthly or weekly payments late? Based on your responses, how do you rate your ability to be a responsible borrower? What changes can you make to improve? Mariah's mom is not sure she even understands what credit is and asks Mariah to compare it to something else. Mariah has a difficult time coming up with a comparison. Can you help her out? Complete the following analogy. Credit is like a car because. An analogy is a comparison of similarities of features or aspects between two things that might otherwise be considered dissimilar. Here are a few examples to get you started. Both credit and a car are tools to get you to a goal. Both credit and a car require an inspection or review to ensure that they work for you. Now, you try. Now we're on to Lesson 2 in this module. This lesson will focus on credit costs. You will examine the possible costs of using credit and how those costs can impact your financial future. Let's revisit Jessie. Jessie found a great deal on a laptop. It regularly sells for $650, but right now it is only $500. Even better, the ad says he can pay just $10 a month for it. His brother reads the fine print and tells Jessie to enter 18 for the interest percentage and 10 for the monthly payment in an online loan payment calculator. Jessie is shocked to see that it will take him 7 years and 10 months to pay off the laptop. In this time, he will have paid $431 in interest charges, bringing the total cost of the laptop to $931. Even worse, he realizes that the loan will last longer than the probable life of the laptop itself. Let's consider a few scenarios. You have the option to buy a computer for $1,400 at 11.9% interest over 4 months, or 15.9% interest over 36 months. Which is better? You have the option to purchase a stereo system for $800 at 13.5% interest over 12 months, or 18% interest over 24 months. Which is better? You have the option to purchase a car for $20,000 at 7% interest over 60 months, or 3.9% interest over 30 months. Which is better? You have the option to purchase a big screen TV at $1,900 at 10% interest with no payments for the first 3 months, then monthly payments for 6 months following. Interest will accrue for the entire 9 months. Or at 11% interest over 12 months. Which is better? You have the option to purchase a truck for $25,000 with a $1,500 rebate at 2.9% interest over 48 months. Or without a rebate at 0.9% interest for 35 months. Which is better? Thinking ahead, today we will answer these questions. How is credit used? What are the typical costs of credit? How do you calculate the cost of using credit? You will use what you learned today to consider borrowing options for a specific situation. By the end of this lesson, you should be able to compare costs and learn to select the best credit option for you. Now to learn the language of credit. Buying on credit means making purchase now and promising to repay later. The principal is the cost of the item bought on credit or the amount of money borrowed. The interest is what the lender charges for using credit, usually a percentage of the principal. For example, Mariah's mom borrowed $10,000, the principal, to buy a used car on credit. By the end of the 3 years, she repaid the amount borrowed plus 3.5% interest for a total repayment of $10,549, meaning her interest cost was an additional $549. Here's another example. Jesse's brother had a flat tire on his car, but he didn't have the money on hand to buy a new tire that day. He was able to purchase a new tire by arranging to repay the $150 owed principal for the tire plus 10% interest in 30 days. Will Jesse's brother pay more or less than $150 for the tire? How could he have avoided paying more than the cost of the tire? Let's calculate this cost of a lump sum to be repaid on a due date for Jesse's brother's tire. Here we find that the interest is calculated using a simple formula. We multiply the principal in dollars by the interest rate as a decimal, by the time paid, which is shown as a fraction. Ultimately, his interest payment wasn't that much, but in other circumstances, interest can really add up over time, depending on the terms of the loan. Lenders actually use a more complex formula to calculate the average monthly payments due on loans. As the principal is paid off on a loan, interest is recalculated on the adjusted lower principal balance. Because this would be cumbersome for someone to recalculate every time a payment is due, the amortization calculation formula is used to figure out the average monthly payment over the term of the loan. Knowing an average amount to be paid each month is helpful when planning a monthly spending plan or budget. Here's an example. This chart shows you the breakdown of a $100 loan borrowed at 40% interest to be repaid in 6 equal payments. We know that, as mentioned before, as principal is paid down, the interest is then applied to the lower outstanding principal amount for each following payment. Over time, you see the changes in the principal amount in column 3 changed as well as the interest in column 4. However, we see the payment never changes in column 2. This is why consistent budgeting is easy with this formula. Here are just a few more terms to know. The annual percentage rate, or the APR, is the consistent way to report interest, including interest rates, fees, and loan costs. The maturity date is when the final payment is due for a loan. A grace period is the amount of time before interest starts accumulating on charged purchases if payment is not received. Let's review the different credit options. Revolving credit, like with a credit card, allows you to charge at any time with no interest charged if the full payment is received by the monthly due date. Revolving credit usually has a high interest rate when balance is carried over each month. Installment credit, like a car loan, allows you to make regular payments to repay the amount owed by a set date. With installment credit, payments and total interest amounts are known up front, which helps with planning ahead. Cash loans allow you to borrow a specific amount of cash to repay later by a set date. Interest rates will vary on these types of loans, so it's very important you compare your options. Service credit may have varying payments from month to month based on use, like with electricity bills. Or it can be more predictable, like with phone bills. Late fees or overuse fees can add to cost if you aren't carefully monitoring these forms of credit. Compound interest is calculated on the initial principal and also on the accumulated interest applied to any unpaid principal during previous loan periods. Look at the figures in the chart. For each month a credit card balance is unpaid, interest is calculated on the new amount owed, which includes the original amount that was borrowed, as well as the amount of interest that was applied to any previously unpaid balances. This sort of interest layering can quickly get out of control and can make it even harder to get caught up. When someone encounters a high interest rate or chooses to make minimal payments, the credit cost can get expensive. Say you bought stuff with your credit card. In fact, you bought $500 worth of stuff with that credit card. Your APR is 18%, and you plan to pay $10 a month. you will end up paying $431 in interest, which brings the final cost of your purchases to $931.40. On top of that blow, it will take you a total of 7 years and 9 months to pay off that balance. Ouch. Let's look at another one. If you owe $3,000 and the APR is 18% and you pay 4% of the current balance, you will end up paying $1,716 in interest, bringing your total cost to $4,716. And it will take you nearly 11 years to pay off that amount. Think about this. After the last payment is made, will you still have the items? Or will you even want what you bought? Take the challenge. Look on page 23 of your workbook. Pick a situation where you or your family currently uses or expects to use credit in the near future. For example, this might be a phone plan, a car loan, school loan, apartment rental, or even a cash loan. Gather information from 2 or 3 different businesses that provide credit for your chosen situation. Use the decide process to select the best option for you or your family's criteria. And here we are in Lesson 3 of Module 2. In this lesson, we're going to look at credit rating. You'll learn what a credit rating is and what factors affect the movement of that rating up or down. Today, you will start down the path to building a reputation as a responsible borrower. Think of a time you needed to borrow something from someone else. Maybe you needed to get some money from your mom to pay for a concert ticket so you can go with your friends this weekend. Maybe you asked your sister to borrow her laptop so you can finish up a school project. Or perhaps you asked your dad to let you borrow his car to go to the mall with your girlfriend or boyfriend. What were you trying to borrow? And were you successful in negotiating a deal to borrow the item? Why or why not? What were the conditions, if any, for you to follow so you could borrow or use the item? Maybe someone asked you to borrow something that belonged to you. When you were asked to loan the item, what influenced your decision to let the person borrow that item? Today, you will learn about strategies to start on the path to establishing a good credit rating. We are going to be answering these questions. How do I get a loan or credit card? Will I automatically get approved for a loan? How much can I borrow? By the end of this lesson, you should be able to outline actions you can take to make a good impression on creditors. This will be your borrowing code of conduct. Mariah and her mom are visiting her community bank so Mariah can apply for a credit card. The bank's customer service representative explains that Mariah is not able to have her own credit card account because she's a minor. However, he hands over an application to Mariah's mom and suggests she consider opening the account with Mariah, added as an authorized user or a joint account holder. An authorized user is able to use the credit card account, but is not legally liable for the balance due on the account. A joint account holder is equally responsible for the balance of the account along with the other person, and is legally liable for any amount due. Mariah watches her mother complete the application, which asks for the following information: full legal name, current address and phone number, date of birth and social security number, current employer, monthly income, bank name and account number, and monthly rent or mortgage payment. While her mom fills out the application, Mariah asks the representative how the bank decides whom to approve. He explains that lenders may use credit scores or look at 5 key criteria known as the 5 C's of credit. What are the 5 C's of credit? Capital. You will need money to borrow money. Lenders appreciate when a borrower is able to cover some of the loan cost with existing cash on hand, such as a savings or checking account. Mariah's mom owns a home and has a savings account. Capacity. No one wants to loan money to someone who has no way to pay. Lenders make sure you have more money coming in than going out. Mariah's mom has a good income, and she's been with her employer for 5 years. Character. Even wealthy people can be irresponsible with their money. Lenders request credit reports on applicants to see how they have used credit in the past. Mariah's mom has established a history of paying bills on time and has kept her debt low over the past 10 years. Collateral. Lenders consider what possessions you can use for collateral to make loans less risky. If you don't pay, you may have to give the lender your collateral as partial compensation for what you owe. Luckily, with credit cards, there's no collateral. Conditions. Lenders may be more lenient about past credit troubles if you can prove you're moving past a bad experience, like identity theft or even unemployment. They will also consider what's happening with the local economy and how this might affect your ability to repay a loan. Fortunately, Mariah and her mother do not have any conditional issues at this time to worry about. Now, you make the call. Using what you know, would you approve or deny their credit application? What do you think? Well, luckily, Mariah and her mother were approved for a $300 account credit limit. We mentioned that lenders will request credit reports on applicants in order to see their character over time. Credit reporting companies collect data about how individuals use credit, and this information is used to rate borrowers. The information in a credit report is used to calculate a credit score on a particular date. The lender uses the score to predict if someone will repay what was borrowed and repay on time. In essence, the lender is using the information available to speculate if someone is a high, medium, or low risk. A low score might be the reason an application is denied, or allowed a low credit limit to start out. Someone with a high score will most likely have lower interest rates or higher credit limits than someone with an average or low score. Information on your credit history will include where you live and work, current credit accounts with balances and limits, payment history, on time or late, recent inquiries from creditors, and any collection or legal action to collect a debt. 3 U.S. credit reporting agencies keep track of how individuals use credit: Equifax, Experian, and TransUnion. This information, in turn, is shared with businesses that request information about a person's credit history, such as credit card providers, lenders, banks, landlords, employers, and insurance companies. A business should have a credible reason to investigate someone's creditworthiness. For example, an auto dealer will request a credit report when someone applies for an auto loan to buy a car. Or a landlord might look at a credit report before deciding whether or not to rent out an apartment to someone. Each of the credit reporting agencies provides a free report once a year. You can check your reports at least once a year to ensure the information is accurate and confirm that no one else is using your identity to access credit. There are even free sites and apps available now that will let you check as often as you like and can offer valuable information to help you stay or get back on track. Think about how you might use credit now or even soon in life. You cannot enter into a credit contract on your own until you are legally an adult. Someone under the age of 21 who applies for a credit card must show proof of income or have a cosigner to be considered to receive a credit card. A cosigner agrees to repay the debt if you don't and will need to be approved by the lender. Even if you don't need loans or credit right now, it is still worthwhile to build the habits for the future. Start strengthening those responsible borrowing habits by returning items you borrow from friends, family, and the library promptly and in good condition. Avoid overdrafts in your checking and savings accounts by tracking all of your deposits and withdrawals regularly. Repay yourself with interest if you borrow money from your savings account. Manage your cash flow so you rarely need to borrow and don't be short when the bills come. Take the challenge. What other actions can you take now to practice sensible borrowing habits and build a good reputation as a borrower? Welcome to Lesson 4 in Module 2. You probably don't think of a loan or credit card application as a contract, but it definitely is. By signing on the dotted line, you're entering into a contract, a legal agreement between you and the lender about what each of you must or must not do. It is important you know your rights as a borrower, as well as your responsibilities. Let's review. What do you think? Is credit good or bad? Don't forget what we went over in Lesson 1. Credit is neither good nor bad. How we use credit can be good or bad, depending on our habits. As we talk about credit costs, contracts, and all of the potentially scary things surrounding credit, don't forget this fact. Today, we will answer the following questions for you. What are my legal responsibilities when I sign a contract? What are guidelines for borrowing? Where can I get help when I have credit problems? You will use what you learned today to outline the responsibilities of borrowing. Even if you decide to limit or avoid borrowing, having some type of credit history can be to your advantage down the road. Having a credit report that shows a history of using credit responsibly can provide benefits such as lower insurance premium rates, less hassle when applying for utilities you need or to rent an apartment, or lower interest rates if you're ever deciding to apply for a credit card, auto loan, or home loan. Remember that lenders use information from credit reports to determine credit scores, which are used to predict if a person will pay bills on time. So which actions actually help your credit score? Paying your bills on time. Yes, paying on time is the single best way to get a good credit score. Opening several accounts in a short period of time. No. Opening several accounts in a short period of time hurts your score, especially when you're just starting out. This makes you look desperate. Owning a credit card you don't ever use. No. Creditors want to see how well you use credit. If there's no activity for a long time, the account may be considered inactive and could even be closed. How about a couple more? Frequently move credit card balances to new cards with better interest rates. No. Card hopping decreases the average age of your credit accounts, and lenders like to see long-term relationships. Getting a credit card when you already have a car and student loan? Yes. Adding a credit card when you only have loans can help because lenders prefer to see a mix of credit types. Let's keep going. Closing a credit card that you made a lot of late payments on. No. Closing an account with negative items won't help. The account will still remain on your credit report for up to 10 years, whether inactive or closed. Using a debit card responsibly. Unfortunately, no. Debit card usage doesn't show up in a credit report because these types of transactions are withdrawals from your own bank account with money already present, rather than borrowing from someone else. Remember, you are entering into a contract when you borrow money, take out a loan, use a credit card, or get a cell phone. A contract is a legal arrangement that two parties agree to uphold. Although repaying what is owed is the right thing to do, borrowers have additional responsibilities to carry out when entering into a contract. There are several potential consequences if someone doesn't follow through on their contractual responsibilities, such as embarrassment if the card is declined at checkout, having property repossessed, being in a state of perpetual debt, which can increase your personal stress, paying higher interest rates and/or late fees, having negative details for others to see on your credit report, having your wages garnished, being contacted by collection agencies, or unplanned expenses for legal action to enforce you to uphold the contract. Let's talk about what makes a contract official so you know now what you're getting into as an adult when you sign a cell phone agreement, use a credit card, sign as a cosigner for a cash loan, or click I agree on the payment page when shopping online. Each of these 6 elements are needed to make a contract binding. Offer. This is what the lender is agreeing to provide and expects in return, including the price and how long the contract will be. Acceptance. By signing the contract, clicking an online I accept button, or simply using what is offered, you're telling the lender you know and accept the terms. Genuine agreement. This means the offer and acceptance are valid and neither side has used fraud or threats. So if you lie on your application, the lender can later say that there was no genuine agreement and ask you to immediately repay the entire amount. Consideration. This is the legal term for the object of value each person gives to the other, usually as money, property, or services. Capacity. This means the legal ability to enter into a contract. The mentally incompetent, minor children, and anyone under the influence of drugs or alcohol do not have legal capacity. Legality. Obviously, you can't have a valid legal contract that involves breaking the law. Ignorance is no excuse for a failed contract. You have to remember to read the fine print. As a borrower, you are responsible for reading the terms and knowing what you're expected to do, repaying the borrowed money plus interest on time, reviewing your monthly billing statements and promptly disputing any fraudulent charges, watching for updates to your agreement from the lender, promptly notifying the lender about any name, address, or phone number changes, and paying any fees, penalties, or collection costs when applicable. Luckily, there are several items on your side to ensure that your rights are respected by lenders. The Consumer Financial Protection Bureau and the Federal Trade Commission are resources for consumer information and guidance should you ever need assistance when dealing with credit problems. Consider visiting each website to tour the consumer resources. Make sure you look into the Equal Credit Opportunity Act, the Fair Credit Reporting Act, the Fair Credit Billing Act, and the Truth in Lending Act for more information. Using credit is borrowing from the lender, but also from your future self. You need to plan ahead to build the repayment into a spending plan, and this is money that won't be available for something else. Know your limits. Taking on too much debt increases the amount paid in fees and interest, which is money that isn't available for other needs and wants, now and in the future. The 2010 rule is a guideline to help borrowers evaluate how much debt is too much. Each borrower needs to take responsibility to determine what is affordable, based on his or her actual situation, not their hoped-for situation. Your total debt should be less than 20% of your total annual net income. Your monthly payments should be less than 10% of your monthly net income. This rule does not include mortgage-related debt. Looking at this chart, take time to figure out what would make up 20% of each person's annual net income. Now calculate what the maximum monthly payments should be for each individual. Pause the video here if you need more time. Let's check your calculations. Based on the formula, We know that Mariah's sister can only support a maximum total debt of $1,300 and a maximum monthly payment of $54.17. Jessie's brother can only support a maximum total debt of $4,950 and a maximum monthly payment of $206.25. Jessie's sister can only support a maximum total debt of $7,160 and a maximum monthly payment of $298.33. What about you? What are your 2010 thresholds? Before you can decide how to borrow, you have to decide if you should borrow. That's easier to do when you're at home looking at your spending plan than when you're at the store staring at something you want to buy. So, to help guide your decision in the heat of the moment, here's a shrewd checklist of questions to ask yourself. Sincere, need or want? Do I truly need it and want it? Happy to pay. Will I still be glad I bought it or still use it when the payment time comes? Room. Is there room in my spending plan for the payments or on my credit card? Extra cost. How much more will it cost me to charge or borrow for this? Is it really worth it? Waiting cost. Is there anything I would lose by waiting until I save enough money? Discipline. Will I be disciplined enough to pay this off or make the required on-time payments? Imagine you were stopped on the street and asked the following question that will be aired on tonight's news segment about credit. What 2 tips can you offer about using credit? Out of everything you've learned about credit so far, which 2 tips are the most important to you that you would want to share them with others? On page 39 of your workbook is Challenge 2C, Credit Code of Behavior. Although you might not need or even be able to use credit now, you are on your way to developing the knowledge and positive habits that will help you avoid the pitfalls of debt problems. Consider how you will use what you learned about credit when you borrow, now and after you become an adult. Write out a personal credit code of behavior. Include guidelines you will follow before considering whether or not to use credit. Include self-imposed rules and habits you will apply as you take on the responsibilities of using credit. You've made it to Lesson 5, the final lesson in Module 2. In this lesson, we will cover identity fraud as well as covering various steps you can take as a borrower to protect yourself against fraud going forward. So what's in your wallet or purse? Go through this checklist and give yourself a point for each item listed below. Do you have a credit card? And if so, how many? Do you have an ID card with a photo, either from school or work? Do you have a $5 bill? What about some change? Is it more than $2? Do you have your original Social Security card in there? Are there any pictures of relatives? Is your computer password tucked away in there somewhere? What about your bank or credit union PIN numbers? Do you have a library card? Is there an old paycheck stub in there? Do you have any deposit slips from your bank or credit union accounts? Do you have any type of money saving coupons? If it's big enough, or there's a place to attach them, what about your car keys? How about a flash drive or memory card? Does it have a pocket that can hold your cell phone? Is your driver's license or state ID in there? Tissues? Any membership cards? Food? How did you score? If you're a high scorer, then unfortunately for you, this game is scored like golf. The one with the lowest score wins. Think about it like this. Your credit card could lead to overspending, potential for someone to use without your permission. Your Social Security number on any of your cards. It's an increased risk for identity theft. Passwords, PINs, paycheck stubs, and deposit slips could all lead to unauthorized access to your information and bank accounts. And what's so scary about having $2 or more in loose change? Well, if you put your loose change in a piggy bank every night, the total collected could be anywhere from $20 to $100 at the end of the month. The main point is that you need to really think about what you carry and why. You also need to keep in mind, should your items be lost, how can someone else use these items to steal your identity? Jessie asks his parents if they have ever been victims of identity fraud. His dad tells him that someone opened a credit card in his name last year and ran up a $12,000 balance and never paid. His dad said that he didn't even know about it until the debt collectors called and demanded payment. He spent hours on the phone trying to prove that he didn't open the account and to have it removed from his credit report. Unfortunately, it's still a mess, and until it's straightened out, it will continue to hurt his credit. Identity theft and fraud are big business, costing victims, companies, and governments more than $37 billion a year. It also impacts our economy because lenders and businesses end up passing down the losses to consumers in the form of higher prices and interest rates. And there are less consumers able to purchase as more and more are taken out by personal identity theft. Today we will answer these questions. How am I at risk for identity fraud? What should I do if I'm a victim of identity fraud? How can I protect my personal information? You will use what you learned today to take preventative action to keep your personal information safe. While theft is terrible, victims of identity fraud pay the biggest price, spending many frustrating hours, days, weeks, months, or even years trying to clear their good name. Identity theft is when your identification documents are taken or online personal files are hacked without your permission. Identity fraud is when your personal information is used to make purchases, withdraw cash, or set up new accounts without your approval. Take the time to search online to find the answers to the following questions. What percentage of identity fraud crimes were committed by someone the victim knew? What are the 5 most common types of identity theft? Teens have something extremely valuable to identity thieves: Social Security numbers with no credit history. In fact, identity fraud for Americans 18 years and under is growing fast. A recent report found 10% had someone else using their Social Security number, a rate that's 51 times higher than the adults studied. Teens 15 to 18 years old were the hardest hit, although kids 11 to 14 years old weren't far behind. But the youngest victim was only 5 months old. This type of fraud is particularly insidious because it's hard to detect, and many go undiscovered for years for 2 reasons. There's currently no way for businesses to verify a name and birth date when the Social Security number belongs to a minor. All they see is a clean credit history, so the criminal can attach any identity to it. Trying to get a credit report for the minor won't work either. Consumers have to give a name and birth date to order a credit report, and those usually won't match the one with the history of fraud. So, the child may still have no credit report at all. Often, the duplicate numbers aren't revealed until the victim applies for a loan or credit card in his or her own name and questions the bad credit the lender found. Identity monitoring, which is different from credit monitoring, may be the only reliable way of detecting fraud sooner rather than later. There's no 100% surefire way to protect yourself from identity theft and fraud. The Federal Trade Commission recommends the Deter, Detect, and Defend strategy to reduce your chances of becoming a victim. Deter. Thwart thieves by safeguarding sensitive information, especially your Social Security number, full birth date, credit card and debit card numbers, bank account numbers, passwords, and personal identification numbers, or PINs. Detect. You are your own best detective, and the sooner you find problems, the less damage you'll have to clean up. Defend. If the worst happens, stay calm and act fast. If you contact a credit card issuer sooner after the theft, the company can't hold you liable for more than $50 in unauthorized purchases, and many offer zero liability, so you might not have to pay anything at all. Seven tips to thwart identity thieves. Here are 7 more strategies to help you steer clear of trouble. Keep sensitive information close to the vest. Don't give to anyone unless you've contacted them and know they're a reputable company. Whenever a business asks for your social security number, ask if you can use another identifier instead. Lighten up your wallet. Only carry your social security card when you need it, like for employment paperwork. Also, leaving unneeded credit and debit cards at home will limit the work if your wallet is lost or stolen. Never leave blanks on a charge slip. Draw lines through them so someone can't add new amounts. Stick to secure web pages. Don't enter personal information on sites you've clicked to from an email link. Type the company's URL into the browser instead. Also, look for a padlock symbol and the HTTPS at the beginning of the URL to confirm that the page is secure. Shred ruthlessly. Shred all credit card solicitations you get in the mail, as well as old documents and receipts with Social Security or complete account numbers on them. Be your computer safe by using firewalls, anti-spyware, and antivirus software. Keep all software and browsers updated, and never enter sensitive information or access financial accounts on a public or unsecure Wi-Fi connection. Guard your smartphone too. They're a treasure trove of personal information these days. Use auto lock with a password. Don't turn Wi-Fi and Bluetooth on until needed. And verify apps are safe by doing a quick online search before downloading anything. Regularly review your accounts and billing statements. The number one way consumers discover fraud is by reviewing their account information. Look specifically for unfamiliar charges or amounts and any other suspicious activity. Sign up for email or text messaging alerts from your financial institutions. Changing a mailing address is the most common way thieves take over existing accounts. Getting alerts for any account changes will help you halt problems fast. Regularly review your credit report. Look for surprises, such as accounts you didn't know about or activity on accounts you haven't used. When you noticed unauthorized charges, or say your purse or wallet is stolen, there are steps you need to take immediately to get a handle on the situation. Document what happened. Collect and write down information that can be used as evidence. Notify the lender or bank immediately. Read your agreement and follow the steps to report your problem. File a police report. With an ID theft report, credit reporting companies can remove fraudulent accounts within 30 days. Report fraud to the Federal Trade Commission. The FTC works with protective agencies around the world to shut down identity theft rings. Request a fraud alert. Contact Equifax, Experian, or TransUnion if you suspect you have been a victim of fraud. Your fraud alert will automatically be shared with the other 2 credit reporting companies. Here's a take-home challenge. Put up your own shield to protect yourself from identity fraud. Create a checklist of at least 5 actions you will take starting now to protect your personal data. Over the next week, document evidence that you have carried out these actions. I hope you enjoyed Lesson 2 on borrowing. Remember, you can pick up workbooks to follow along in these lessons at either of the 5 branches of the Livingston Parish Library. Join us again next week for Lesson 3, which will focus on earning power. As always, we hope to see you again at your Livingston Parish Library.